Kick it off just a little bit early, allow some folks to come on into the forum. I think a few people were kind of waiting this week to hit me up with some direct questions. So I'll kick it off a little bit early so I can kind of talk a little bit about the week. I've been ecstatic. I've just been, I've been entertained, to be honest with you, with volatility in the stock market. This week, we sure did end on a down note. I actually, I made some buys this week in my total stock index. I picked up some more shares of Coke. So really the only strategic, yay, welcome to the group. I'm just going to give it a couple minutes for everybody to kind of get in here. I don't know how these live streams are going to morph as we get in. Yeah, what's going on? One of my long-standing subscribers, long time. Nice, very cool. Nice to see you. Yeah, it's been a killer week. I look forward to this now, to be honest with you. I want to make sure that we're turning back value to you guys. That's the most important thing. This isn't about me, honestly. If I didn't think you guys were getting value, hell, I wouldn't do it. It's that simple. But it just gives a little bit different of a twist, kind of allows you guys, if you've got some lingering questions, hit me up. And you know, again, talk about the benefit of both the Facebook group and the benefit, you know, of being able to just shoot some questions my way. You know, I always say in the stock market, there's really no right or wrong answer. There isn't. Anybody who tells you that they have a definitive, you've got to go this way, or a definitive, you've got to go this way, that stuff just, it doesn't exist in the stock market. And I think when the stock market cranks out this much vulnerability, the first thing that you'll see folks do is you'll jump on a bandwagon of starting to blame people. It's blame this, blame China, blame Trump, blame everybody. It's everybody's fault. It's Powell's fault, you know. And I wanted to buy some Coke. I only bought 5 shares actually this week. I'm really trying to keep. I'm only buying right now, no doubt about it, but I wasn't going to allow the Dow to go down 700. You guys saw that we dipped just below the 200-day moving average on the S&P 500, which usually sells a pretty good buy indication. So that I'm an opportunistic investor, no doubt. I'm a long-term investor. So I calmly sit there and watch the stock market go down, and then I put in my buy order. I think I got my buy-in around 700, I think, down today. So I was happy with it. Where I'm trying to kind of get you guys to evolve to is, you know, emotionally, you want to just sell everything and throw in the towel. But the most, you got to kind of be like a robot when you're looking at the stock market. There's nothing human about it. Warren Buffett says that stocks don't care how much you sit there and worry about it, or if you're going to lose sleep over it. A stock doesn't care. Okay, it doesn't care. It's going to go where it's going to go over time. It's that simple. So it doesn't matter how much worrying you think about, or, oh my goodness, it's gone up, what do I do with it? Nothing of that matters when you're looking at the stock market. And you really have to take kind of a robotic approach. You really do. I mean, when you start to look at the stock market and you're like, oh no, it's down 750, you almost have to do the opposite and be like, it's fine. It's fine. It's always fine. And it comes with time. And that's a lot of what, you know, when I came out with the channel, I was trying to get folks to really understand, look, the stock market does go up. And I came out with it at the beginning of 2017, and everything was rosy in the stock market. It was abnormal. I was one of the only guys online talking about, you know, and kind of a rule of thumb when you're talking about the stock market is it's never really as good as it seems, and it's never really as bad as it seems, right? So 2017 was kind of one of those years to where all year, it was really, really difficult to get an injection point into the stock market. If you did end up investing at some point, you would have got some capital appreciation all the way through December. But, you know, 2018 is like the inverse of 2017. In 2018, it's never really as bad as it seems, you know, unless you want to sit there and buy into it. And I think what I'm hearing a lot is there's a lot of blame going on, you know, and I embarked on this recommending something that's very scary to people, because here's the thing. I recommend a strategy that works for somebody, I will hear nothing about it. Nothing. Very rarely. Every now and then I get a, hey, thanks, Ryan. That was great. Thank you for the channel. You're doing great things. That's awesome. That's awesome. Because at the end of the day, I wish my advice was just taken by people and everybody succeeded in it. Okay. But I tell you what, you make one bad money decision for somebody, they're going to hate you the rest of your life. I mean, it's really one of those sensitive topics to where everybody expects you to deliver magic all the time to them. And I think what I try to teach upon is to really look within yourself and, don't worry about things that you can't control. You cannot control what China does in response to the Trump tariffs. You cannot control the decisions that our administration make now in regard to how you formulate your portfolio, right? So I think the idea is control what it is that you can control. Put your program on the best possible program to benefit you going forward, irregardless of what the stock market is doing. And right now, I'm kind of taking an opportunistic approach to the stock market. Whether or not it continues south, I don't know. I can't control that. But if the stock market's down 700, I'm going to take advantage of that every single time. The idea is not to overexpose. So you've got the opportunity to kind of take advantage when those opportunities present themselves. And I thought today was one of those opportunities right there against that 200-day moving average in the S&P 500. So hopefully you guys felt welcome to you guys that are coming to the group. Very cool. I learned that from you and Jeremy and Ryan. And now I'm like, oh, it's so cheap. Yeah. All this volatility, honestly, we've come back 3,000 off of the highs for the Dow. And, every time it's going down, the underlying stock market is still good. Make no mistake about it. But the stock market and the economy are two different things. So you guys have to really understand, just because the underlying fundamentals of the economy are doing well, doesn't mean that it's going to just automatically reflect well in the stock market. And right now, I feel like they're kind of going on intersecting paths as opposed to parallel paths. All right. So I got hit up with a question here. Market's down, time to buy. Yes, not to get too overexposed. It's one of those things to where you always have the choice to buy, sell, or hold. I take the option to sell off the table when this is going on. I did a lot of selling in 2017 because you could trip, fall on your face and make money in 2017. It's a little bit harder now in 2018, but with all the volatility, certainly don't want to pass up on, good injection points. And that's why I talk about strategic buying. If you're dollar cost averaging and you're entering the same amount of money into the stock market every single month, or you do it all at once, I think it's better if you kind of keep a little bit of cash on the side, and on a down day like this, you can really kind of take advantage, of that volatility and kind of get a better entry point on stocks. And you do that month over month, year after year. I don't consider that timing the market. I just consider that paying attention and monitoring the market. So I've got a question here. Hey, Ryan, what do you think about Dave Ramsey's investment philosophy of owning only 4 mutual funds, one growth and income, one aggressive growth, and one international fund? Yeah, so I've seen Ramsey's approach to this. The one thing about it is, and I love Dave Ramsey. Here's the thing. I think Dave Ramsey gives a message that helps people, and I think he genuinely wants to help people. I get that. When he was talking about his mutual funds, he was talking about the performance at 10 to 12 year over year, and that it's easy to find, and that mutual funds can perform that way year over year. And I'm not really sure. I was a little bit taken back a little bit as to why those products aren't more openly shared, with the general viewing audience. And so if he's identified those funds, offer those out there. Now, if you guys are students of Dave Ramsey and you follow him, and you know what mutual funds he's talking about to recommend to folks, to just say, look, invest in these 4 mutual funds. It'll pay off over time. I have no doubt that Dave Ramsey has access to the very best managed funds. I would ask two questions with regard to the funds that he is investing in. Number one, what is the expense ratio in the fund? It's that simple. You guys can use my compounding calculator on the Facebook group. I believe I've pinned that to the top because I want each and every one of you guys to kind of play with that and look at what a 3% expense ratio in a fund will cost. Most mutual funds that I look at are 1.5 expense. You're losing right off of the top. So even though he's getting a performance of, let's say, 12%, so he professes, he's not making 12%. When you take into account the cost basis within that mutual fund, you have to take that 1.5 off the top. You're not, just because they tell you that a mutual fund is making 12% year over year, it doesn't mean that the real dollar amount that you're making is 12%. It's 10.5%. That's the real dollar amount because you have to take into consideration the fees. Now, you have to take that year over year and you have to compare it to what you could make in a passive vehicle, a passive ETF in the stock market. So the question becomes, if you can do just as good or better in a passive ETF, you go with the ETF every single time, right? And furthermore, you talk about these assets all the time, and a lot of people want to do it. They want to offer the perfect stock. Ramsey's mutual fund program is a very, very good program for a lot of people. My question is, what account are you housing these assets in? That is the most important question. And somebody with the audience that Dave has, he's got the ability to touch a lot of people. And when I reach out to folks, this is a topic that a lot of folks won't touch. Like they will not touch this because it doesn't benefit the money managers, right? It benefits individuals. So I'm not really keen on recommending people get involved with mutual funds that benefit a third party, right? Because the statistics show that the folks that are managing those accounts and trying to outperform and provide alpha for individual investors, they're failing at doing so, okay? So I like the program. I advocate for it. If somebody resonates with the Ramsey program and it helps them get a budget in line and it helps them save for their future, he's really hard on Americans as far as, if you don't have any money when you retire, it's kind of your fault. And he's right. There's really no excuse, where there's all kinds of countries around the world that struggle to save anything. And in America, I think it's a little easier to come by if you just kind of identify in your budgets, maybe a few dollars that you can start to kind of build upon each other and go. Thank you for the question. That was awesome. Finally caught you live. Yeah. I look forward to this. I think it's pretty cool. I had a hard week this week. I busted my tail off this week. But I actually this doesn't work for me at all. This is, I try to really engage with what you guys need and try to provide that. I know a lot of people, and I owe some thank you, but I'm not going to drop names on a live YouTube feed. But the help that's going on in the YouTube group or the Facebook group is actually much appreciated by me. And I know there's a lot of new investors that are benefiting from that. Comparatively speaking, I always compare, my history and evolution as an investor coming up through the ranks, and having a limited time to my financial planner. I loved going and talking to my financial planner. I loved it. It's my favorite topic, but once you're 15, 20 minutes, maybe a half hour's up, they've got other appointments to get to. And I would just as soon sit there all afternoon and talk finances. It's a fun topic. And I think the group really intends on helping folks, and there's no money involved. That's the beauty of it. People have a genuine concern. They can kind of drop it in the group and get the opinion of multiple people. So there's really good things going. I tend to try to monitor a lot of the responses that people are getting. I don't want anybody to be misled because there's a few fundamental premises that I insist that every person enjoy inside of their portfolios. And I won't deviate from that, guys. I will not deviate from that message. My niche on this channel is to offer, if you guys have $5,500 or less to invest per year, there's no other account that you need to be looking at other than a self-directed account. And if you do not know what I mean by self-directed and you're new to the channel, hit me up directly and I will tell you exactly how that relates to wealth preservation. I just welcomed a lot of new members to my Facebook group, and that was one of the key principles. I want you guys to understand the importance of the bucket that your assets go in, the importance of wealth preservation, and how that self-directed account really is interlocked with that wealth preservation piece and what that means. And finally, the importance of tax protection. And you can meet all three of those goals by just following, the 3 simple steps in the program. It's really simple. And, a lot of people don't get invested because they don't think that they have adequate knowledge. And I tell you what, if you guys have knowledge enough to own a savings account and a checking account, then you have enough knowledge enough to follow my very simple 1, 2, 3 process and start an investing account, guys. It's really that simple. And I'm sorry if you have a misconception about it, but there's really no reason whatsoever to not participate in the stock market because you don't think you have the type of knowledge that the analysts. I just saw this week that a lot of people are pulling out of Pershing Square, and people are finally figuring it out. If for you guys that don't know, Bill Ackman is the one that runs Pershing Square. It's a multi-billion-dollar hedge fund. Made probably one of the worst trades in the history. Lost $4 billion on Valiant Pharmaceutical. Traded out of the stock at its very, very bottom, $10. It's come back at 15. And his excuse for all of his account holders was that they didn't have time to manage the account. Are you kidding me? You had to work that hard to lose $4 billion. My sympathy goes out to you, honestly. There's no excuse for that. You're not losing $4 billion, guys, on good quality cornerstones that I recommend, good blue chips. And I'm just a simple guy. I don't have all the answers. What I do is I have answers that actually work and are proven over time. It's that simple. I'm not one of those, hey, this is the next best thing coming along and somehow you need to ride a 30, 40% upswing in a stock. I don't invest that way. I do not underappreciate the importance of dividends in the stocks that you buy. So I bought 25 shares of Home Depot this week as well. 170 was my entry. So I was happy with that for sure. You're welcome for your answer, by the way. What's your opinion on the EU market? I'm partial to the US. I would like to pick up the Vanguard's Europe fund, no doubt about it. Through my networks of folks talking right now, and I know I've got one of my very, very loyal subscribers who's from India. My understanding right now is that India is on fire right now. So, I have half of my family's from Europe that I live with, but I can't speak necessarily about how good or how bad. I know the economy in Europe is established and it's good. If you guys fancy having a portion of your portfolio, I certainly recommend taking the good old ETF route, pulling off the Vanguard Europe Exposure ETF, if that's what you want to do. But again, I would rather have you take that broad-based diversification in the market, pick up some VTI, pick up your VOO, which is going to be, your S&P 500. I think you can win with multiple options, guys. I really do. I don't think because you invest in either Exxon or Chevron that you can't win with both, right? As long as the assets are housed in the right account. And I do have some international exposure in my TSP. A lot of you guys know I am a military member and I've participated in the TSP, and I make sure that I have 15% of that particular portfolio that's devoted to international stock. It's not specific to Europe, I don't believe. I believe it's got a pretty good basket of international exposure in that basket of stocks, but I've won with it. I mean, it's fine. It'll perform for you. I think Europe, emerging. I think China, Japan are fabulous opportunities right now. And I also think India is a great opportunity. If you guys are into that international, just, set a plan to put an exposure of 10 to 15%, do it through an ETF and go ahead and work that angle. You guys, you can win with it. as long as the money that you're making is preserved and tax protected, right? So it's a counterbalance. It's a pendulum of always trying to look for the very best investment, but never ever forgetting the importance of the bucket that those assets are housed in. Okay, it's very, very important. So, hey, Ryan, when you get a chance to answer, what strategy do you use after you're exhausted all your resources in a Roth? What's next? I was kind of joking. One of my friends, Scribner, he put a post this week on Facebook, and there was a ton of folks going on there kind of airing their dirty laundry about how upset they were with the stock market, et cetera, right? And you guys have to understand, I'm teaching you about philosophies that you can put to work in the stock market so you don't have to work so hard in the stock market, okay? One of the mistakes that I talk about in my latest video that if you haven't watched yet, I encourage you to kick over. It's a really good video. I've made every mistake on the video, and it's very, very difficult when you are a new investor to want to invest everything that you have. Now, is it overexposed as a young person to invest every dollar you have? I don't know. It's relative. It really depends. But I always contend to try to say, if you have X amount of dollars, let's say $1,000, invest 500, or invest 25% of it. Always keep a good amount of cash on the side. And what differs in my message as opposed to what you're going to get when you go in with a financial planner is if you tell them you've got $1,000, they're going to want it all. Okay. They don't care about dips in the market. They don't care about a rainy day fund. They don't care about a sleep easy fund. They don't care anything about that. All they care about is bringing more money into and putting it under the umbrella of care, assets under management, AUM. That's all they care about. All right. When you leave that door, if they've got every single dollar from you that you can possibly cough up during that appointment, then they've done their job. Hell, if they can put you into some of their proprietary mutual funds that they get a higher kickback on, then they've also done their job there as well. If you've exhausted all of your funds, try to reevaluate your program. That's my advice to you. It really is. What I mean by that is if you've got your money invested in a self-directed account in good quality assets, you're good there, okay? So reevaluate your budget, reevaluate maybe saving a few dollars, cinch it down a little bit. I'm not telling you not to get a little bit aggressive on this stock market and be like, you're not. So many people want to beat themselves up. Oh my God, I invest in the stock market and it goes down. Volatility goes up because I invested in the stock market. No, it just means that you bought stock at an unopportune time. That's all it means. It doesn't mean you're a bad person. Okay. So what do? You let that money continue to work and you exercise your right to hold. What do you do over here? You can reallocate your budget, right? Find a little extra dollar, work really, really hard to build back up those cash reserves, right? Cash is king in this environment. Cash is the best hedge you can have against a market downturn because you're going to take advantage of recessed prices. Trust me, guys, people are selling right now, okay? People are panicking and they're selling. Nobody in my group should be, all right? I'm sure not. I'm buying. I'm buying. When everybody else is selling, I'm buying. But I hope that helps you kind of understand and learn from this. Learn from the evolution of being like, wow, maybe now in reflection, I put too much to work in the stock market. If I had it to do over again, what would I have done? I did this right over here, but maybe I wouldn't have invested so much in the stock market all at once because, man, it would sure be nice to have a little bit over here in what Ryan calls the sleep easy fund, the rainy day fund, right? To go ahead and allocate a little bit more to the stock market. Now, if you're maxed out on your Roth IRA, remember, we've still got time to contribute for 2017, $5,500 for 2017 up till April 2017. So we've got a couple weeks left or about 10 days left, give or take a little bit, to do 2017 contributions. And then, of course, we're in the overlap period for 2018 contributions, which is another 5,500, right? So at any one given time, if you haven't done the full 11,000 to cover 17 and 18 contributions, then there's still a little bit of tax protected contributions you can make to the Roth. But certainly if you've made those max contributions, look at building up those cash reserves again on the side. That's exactly what I'm doing right now. I'm working really, really hard to get that cash account built up. All right. GIS, General Mills, it's probably one of the biggest buys right now, guys. I've got some stocks right now. I mean, Comcast, I've got on my list at 7.5 times. I did pick up some shares of VTI this week. I already told you guys I picked up some Coke, but definitely General Mills is a buy right here. I think Kraft Foods is a buy. Some of the most old school, boring stocks that you can possibly get involved with are some of the very best investments that you can get involved with. So yeah, definitely want to look at that as an option. I think I looked at it this week, and I was actually tempted to pull the trigger. I think it's one of the best staples you can buy. So thank you for your question. I would buy it. I have 35% in EU ETFs, the rest in North America. Yeah, I like that. Whatever you guys are comfortable with. The thing that's cool about the self-directed account is you guys can kind of, put together a plan. You might outperform in Europe. So, is my recommendation to have 15% in there, or what you have 35%? This is a money game, guys. If you put a little bit more risk into what you feel is an undervalued stock market, which it is right now, and you end up winning out, then you're the winner. No doubt about it. You're right, and I'm less right. That's what it means, So yeah, I think that's a good weighting. I really do. I think that's good. You're welcome. Hey, yeah, nice. I got Average Joe, man. That's awesome, guy. We kind of started YouTube together, man. That's nice to see you. That's very cool, man. Very cool. Nice to see you. We're just kind of talking about the volatility during the week. It's so crazy to kind of hear everybody buying into, all the negativity right now. I don't know. I've just been really hardened. I actually get happy when the stock market goes down because it actually provides me a very obvious buy point. Like I was stoked to buy stock today in the VTI when it was down 700. It bounced right off of the 200-day moving average. So, it's going to shake out at some point, guys. You'll reflect back on this and say, gosh, I wish I would have invested more. Or, wow, I wish I wouldn't have panicked and sold out. It's one of those things. Need a stock in the healthcare sector, J&J, Abbott Laboratories, Medtronic, Pfizer, or Merck. What would you choose? They're all good, all of them. I own J&J, I own Pfizer, and I own Merck. At an attempt to go for the best of the breed, you certainly have to separate your growth from your value. I have 3 value plays in my portfolio. I just love the fat dividend that they pay. I took a trading position in Merck at the beginning of the year and made out quite nice. It ran into the 60s quick. It's actually come back into the low 50s right here. So I think you're getting a great recessed entry point into Merck. Same thing with Pfizer right here, just below 35 a share. Medtronic's a much more of a growth name in the robotics, and I like it a lot more than Intuit Surgical, which I feel is overvalued. Certainly, Scribner did a nice piece on some valuation stocks that he's top 5 overvalued stocks this week. So I recommend that you guys kick over and watch that. He did a good job on it, really good. Actually come talk to me out of selling Amazon. I thought I'd made a mistake, but today kind of validated my position. I could have been right holding Amazon, but when you have 10 shares of it and you're watching it go down that fast, it's I didn't really want to own all 3 of the Facebook, Google, Apple, and Amazon at the same time. So Amazon was the one that I actually stopped myself out of. And somebody asked me what stopped out means. I had a very, very tight collar on that stock. And I wasn't going to allow it to free fall down on me. So I actually had a stop price that I wasn't comfortable going below, and I actually sold it for a little bit of loss. But that was fun. I mean, I made a ton of money on it last year trading in and out of it. So that's fun. Sometimes you do cut losses, and you just do not want to make a habit of that. Really, Warren Buffett says never sell in the red. And that's pretty credible advice. I spent $1,000 today. Feels great. Yeah, honestly, it's kind of sick, I guess. I don't know. Maybe we should have our head examined. But it's the right way to invest. You just can't get emotional at all. These news medias are out of control, man. I swear. That's another thing you can do when you've exhausted all of your investment capital, is to do something else. I was kind of being funny. I said, go to the gym, work out, read a book, for crying out loud, play some guitar, do something other than sit there and stare at the stock market. It doesn't matter how much you stare at it, man. It's going to go down, or it's going to go up. There's no amount of worrying about it that's going to impact, what the stock market's doing from day to day. J&J and AbbVie are good right now. I agree. Yeah, I tell you what, I missed out on AbbVie. I was going to pick that up in the mid 50s, man. That would have been a nice doubler for me. I really missed out, but that's all right. The more time you get in the stock market, you're going to have more of those reflections where you're like, oh, what if that? And I don't want you guys to discredit those lessons. For you guys that have invested in the stock market, I want you to continually reflect on what you've done, what you could have done better, what you're going to do better next time. What are the certain areas that you can focus on to kind of build up your financial health? Because trust me, every day that comes and goes, as an investor, you're becoming more and more seasoned as an investor. And as the years kind of pile onto themselves, you're really going to enjoy how hardened you're going to get. More specifically, you're just going to be evolving as an investor, something that somebody who sits on the sideline cannot relate with unless you're involved in the stock market and you understand all the benefits and all the perils and pitfalls of the stock market. All right. Got some cool questions tonight. Are you still holding Facebook? Yeah, I'm not selling Facebook ever. Facebook's one of those companies, as it's run up. I mean, it's really not that old. It's been around for what, 15 years? Is that about right? Somebody can correct me in the group if they will. I watched it. It came out with its IPO, in between $30 and $40. It dropped down to $18 a share right when it came out. Woulda, coulda, shoulda picked up Facebook then and there. I knew it was going to be a winner. And now run up, it's never split. The stock has never split. It's flirting in between 150 and 160 right now. I think Facebook is absolutely a screaming buy right now. There are a few stocks that you'll look at over our lifetime, and you'll wonder why you didn't get involved in it. And I think this is providing that opportunity. It's obviously hard when there's this much noise going on about the stock. Zuckerberg's going before the committee next week. That's going to be interesting, and I hope he goes at them. I honestly do. They're going to try to spin it in a political way, but I hope he stands firm, and I hope he basically says, "Look." I've built this from the ground, and I hope he actually defends the company. I really do. I'm holding Facebook. I have 75 shares of it. Absolutely. I'm glad to own it. I picked it up. It was approaching 150, and I snagged my additional 15 shares right there. But it was interesting today on a down market. It was holding in there pretty good all the way up until Powell started his remarks, and then it started to kind of slippery slope with the rest of the market. Yeah, I'm long Facebook, no doubt about it. That's contained within the Roth IRA. So I want to make sure that the growth that I get out of that is all contained and wealth preserved. That's a stock that's going to be a multi-bagger someday, no doubt. I'll own it the rest of my life, and I'll be right, wrong, or equal, I guess. But I'm willing to take that chance with I've got 6% of my total overall portfolio in Facebook, to answer your question. So would you recommend rolling a 401k into a Roth? No, that's a great question. I'm glad somebody brought it up in the group. Those are the strategic, and don't hesitate to hit me up with those kind of questions, because I think my answer might surprise you. I'm not one of those guys who willy-nilly says you got to throw your money around like a crazy animal. If you've got a good 401k in place and you're happy with it, especially if that 401k allows you to invest and enjoy some matching, keep the 401k. But that doesn't mean that you can't start a self-directed account on top of your 401k. So for you guys that know and have been turning into the channel, I'm with the military, so I do the TSP. That's my form of 401k, and it's just another bucket that I use. Is it the best bucket out there? I contend no. That's why I like my self-directed account, because I have more freedom in it, and I know my money is a lot more liberated to grow the way I think it will grow in the future. But that doesn't mean that I just do away with my TSP. And in your case, keep that 401k, right? It's a great fundamental base, and that fundamental base allows you to strategically build the Roth IRA in maybe a little bit more aggressive form. What I mean by that is, if you've got a good diversified base in 401k, I'd like you to tell me who actually sponsors the 401k for your employer. That would be kind of cool. And then to really understand what holdings you have in that 401k, I really find that a lot of people invest in the 401k and they don't know what in the heck they have in there. That's a big no-no. You've got to spend a little bit of time understanding what you're throwing money to, okay? Because if they've just invested you into a bond fund and you end up doing a bond fund in your 401k for the rest of your life, you're not going to enjoy the good accumulation over time if you're not enjoying some of the better funds that may be eligible in that. And I've helped people look at their 401ks, and it's amazing the difference of funds that they offer to you. I think they do that on purpose, because really they don't care that you pick the right product. All they care about is that they get as much money as they can. They're providing you a service and being paid by your employer to offer that service to you, right? So who's going to have your best interest in mind more than you? Nobody, in my opinion. So you really need to know what's offered through your 401k. But I've made videos on this before, and I always contend do both. Do both. It's never, ever going to hurt. Put as much money as you can away for your future. But don't underestimate the power of having both. That's what I do. Okay. That's an awesome question. Thank you. In your Merrill Edge Roth IRA, under estimated income, does it show your dividends as taxable? It shows General Mills, Disney, and Apple for me as taxable. It's not. It shouldn't be taxable at all. No, it does not show that. So I would make sure that you have the right account. That's not right. It may show that it's taxable on the statement. This is for Michael, who hit me up with this question. This is a really good question, and I've actually noticed this as well. But any asset, any dividend that's paid to you, any capital appreciation can be rolled back into the stock under a Roth IRA umbrella, and you are not taxed for that money. Okay, so there may be a differentiation between yes, it's taxable, not housed under the proper umbrella. But if it is housed under that proper umbrella, you will never be hit with that tax. Furthermore, I think they may be kind of letting you know, look, it's taxable if in fact you pull it out early. Okay, that may be what they're alluding to, because you do have to make it to that threshold of 59.5 before you can withdraw those capital gains, and dividends as well are rolled into that tax-free. So that may be what they're alluding to. But you want to keep those dollars in there until you at least reach that 59.5 anyway. All right. What do you think about Tesla? Would have been a great trade, no doubt about it. When it hit the 250 mark, it was so oversold at that point that they have the stats of that thing going up close to 90%. And it skyrocketed. I mean, it went up $65 a share here this week. As far as a stock, I'm not interested. I'm not interested in Tesla. There's so many more value plays out there that I would rather grab a hold of in the technology sector. I don't invest in autos. So whatever category you want to put Tesla in, I like the car. I'll never own one. Would I drive one for free? Yes, I would. If somebody wants to allow me to borrow their Tesla, I'll drive it for free. But I don't need that. I don't have any desire to roll a Tesla down the road. I'm perfectly fine with my Toyota truck that I drive with 200,000 miles on it. I'm not into putting a lot of money into depreciating assets. I'm not. And Tesla, as far as a stock goes, until they start making money, I think the stock is valued at zero. That's just my opinion. There should be no value in Tesla at all. I mean, I've got companies like the one I recommended. I've got Comcast right now. That's a $75 billion company trading at a 7.5 PE right now. I mean, geez Louise, guys, if you could pick up General Electric, you get $150 billion of net worth there. $13 a share. I'd much rather be in General Electric than Tesla. Sorry. Awesome question, though. I really appreciate that. That's awesome. MJ stocks in Canada are good because Canada has no regulations compared to here in the US. Yeah, I addressed this last time. Canada's way ahead of the US, actually, as far as this goes. Haven't studied much of the research and the impact or the health impacts that folks are getting in Canada. I'm sure that they've got more advanced data because we just haven't provided that opportunity here in the US. I tend to try to keep my comments with regard to this topic close to the vest. So please understand if I don't be as specific as maybe as I want to be, but I just can't do that on a live feed. But thank you for the question. I agree. Canada's got a much better head start. And I actually think it shows in some of the companies that are available through Canada, as opposed to really GW Pharma, which is the only company that I would ever look to invest in. I don't invest in it here in the US, but much more evolved in some of the companies along the spectrums that you would invest in the MJ realm. I don't invest in MJ. I don't. Again, it's one of those things where I'm looking for best of the breed. I'm looking for quality. If you guys wanted to piece out an aggressive section and that's really what you wanted to put your dollars to work in, then so be it. That's great. I'm all for it. As long as you are willing to take on the applicable risk associated with that particular topic. All right. T. Rowe Price holds my 401k. Okay. Just redistributed everything into Vanguard ETFs for way better expense ratio. Oh, that's awesome. Yes. Great. I'm opening up a Merrill Edge self-directed Roth. Oh my gosh, man, you're doing everything right. That's so I think I told the group, I called Vanguard directly a couple weeks ago. I was actually thinking about switching to them, and a great brokerage. The problem I had was with their incentive program, their Voyager program. The incentives kick in at $500,000 and you get reduced trades. And I was like, reduced trades? You're kidding, with $500,000. It's not till you have $1 million with Vanguard under the Voyager program that they actually start offering an incentive in way of free trades. Merrill Edge, they do kick those incentives in at $50,000. You have to be part of the Bank of America Power Rewards program, which is free of charge to join it because the benefits are insurmountable. There's a lot of other benefits that I enjoy being part of that program. Free trades is one of them. At the 50,000 threshold, you get 30 free trades. At 100,000, you get 100 free trades, which is basically unlimited. So. And I don't talk to you guys, again, I've explained this before. I don't talk to you guys in a manner that doesn't anticipate that your accounts are going to be at that, $1,000, $10,000, $25,000, $50,000 thresholds. If you just stick to the plan and don't kind of tinker with it, you'll be there. If you're starting with zero, you'll be to those goals. You just got to set and meet those financial goals. Average Joe, Love the 401k along with investing in stocks. My company matches. Yep, you always want to take that free money. This is one of my other channel creators, man. He does such a good job on his channel, man. He's been one of my featured channels for a long, long time, and there's a very deep reason why I endorse Average Joe Investing, man. I get the same sincere approach from his dialogue on his videos that hopefully people get from mine. That's about as big a comment as I can give to Average Joe Investing, no doubt about it. Our philosophies in investing have kind of, he's got a good way of investing, and so do I. And I really think that it's kind of cool to show a couple different philosophies and examples of what can work in the stock market and kind of prove. I know he would agree with me that there's really no one way, to make money in the stock market. There's many ways. Unfortunately, there's a lot of wrong ways. But the 6%, so he's talking about his matching. So I'm putting away basically 12% plus an additional 10 to 15 every paycheck. I know a lot of people have a hard time doing this. Man, I had a statistic that less than 50% or 50% of Americans actually save less than 10% of their income. That's a fact. So if you're saving over 10%, you're in that upper 50%, right, of actual total savings for Americans that live here. So, I mean, you're doing awesome, man. You're doing awesome. You can manage to work around your spending. It's 100% possible. Yeah, it's so funny, man, that you say that, because I think every one of us, myself included, could probably identify what little bit, if we took 100% of our paycheck and we identified that we have 3% of loss in that paycheck, you're probably doing pretty good. But if you're living paycheck to paycheck, no matter what it is, if you're making $1,000 a month, guys, I used to be there. I used to make nothing a month. I used to commercial fish in Alaska. I did it for years. So I would go for months and not make a dime. The bills are still stacking up over here, and I'd make nothing over here, nothing. Then I'd get an injection of big, and so I had to quickly backfill and have fun and pay bills at the same time. But I think a lot of people, if they just, use a planning app, do a financial budget, will really, really help and kind of identify that maybe a lot more than, a couple percentage points of that paycheck is being lost and just wasted, away every month. And if you could just do away with a few luxury items, perhaps maybe you could kind of pull that $100 or $200 a month to put into a nice investing account. I read Harry Dent's book, Sale of a Lifetime, and most big corrections in his book happened during fall. It's so scary and exciting at the same time. Really? Yeah, that's interesting. I have not read that book. I've kind of done away. I was hit this week on, do you try to pick, cyclical stocks? Do you try to pick cyclical mutual funds and try to play it that way? I get more and more simple in my process as I evolve an investor, guys. And I honestly laugh when the market does this today. I'm so hardened, and I hope you guys take that not as arrogance or cockiness at all. It's just the mentality that you honestly have to have, because if you start buying into all this noise, it's going to kind of consume you, and you're really going to you're going to want to act on those emotions. And certainly that's not something that you ever want to do. Put it away correctly. The way I'm teaching you guys to put away money, if it's, $10 a month, if it's going into the right account, man, at least you can take some, solitude in the fact that you're investing correctly. And so many people out there that think that, especially if they have money, they think that because they have money, they're entitled to think that they're good with money. And in most cases, there's no saving those folks at all. There's no way that you can change their mind to thinking that somebody without money, me, some working class guy is going to tell them that maybe their strategy doesn't quite work and actually show them on paper why it doesn't work. They don't want to hear that stuff. They really don't. But for you guys that are hearing it, man, it's relative. It doesn't matter how much you start with, as long as you're doing it correctly and you're taking into consider wealth preservation and tax protection in your 401k. As a new investor, would you build cash, wait till some bottom is felt before jumping, or hold long to make up any stock losses with dividends? Yeah, so the first part of your question, I actually get that impulse. I watch the stock market every day, but it's really hard for me to talk to new investors and say or advocate for picking a bottom, picking a time to, as you put it, jump into the stock market, right? Most of the folks that I listen to, J.L. Collins is now one of my favorite people to talk about this very topic. And he's like, you never know what the stock market is going to do tomorrow. You don't know what it's going to do 5 or 10 years down the line. The point is, the best time to invest is today. That's it. And right, wrong, or indifferent, that is very, very sound advice. And it kind of takes away the perspective of thinking that somehow you need to pick the bottom. Now, was my buying stock today an attempt at timing the market? No. I just made an observation that the stock market was at one certain point down 750 points. I looked at the 200-day moving average, and I thought if it was breached, it would have continued to go lower. It actually did get breached, and it actually turned and went back north, closed down 585, I believe, on the Dow today. My point is, I could be wrong on that decision to enter the market today, okay? But I strategically buy the market on opportunities like this, because on any one given day, if you guys are new to investing in the stock market, you've noticed that the stock market does one of two things on any given day. Either it goes up or it goes down. Okay. Now, wouldn't you rather strategically buy on a red day, and especially a severe red day like today, where at one point it was down 700? So this is how I did it, guys. I sat here and I watched it. I hit refresh a couple times. I watched it continue down, and I thought, you know what? I'm comfortable. I'm going to go ahead and make my injection. I picked up 15 more shares, 10 more shares of VTI, I think. So I've got 125 shares now of VTI. And one thing I kind of wanted to tell you guys and pass to you guys, if you guys have tuned into me for 51 minutes, that's pretty awesome. But I'm going to give you a kind of a secret that I found out. I've actually talked about this on my channel, that ETFs are ineligible for dividend reinvestment. That's not true. My VOO and my VTI just paid me my fat dividends. They paid at the same time, and both of them dividend reinvested. I had the setting set to dividend reinvest capital gains and dividends, and it actually bought shares for me. So ETFs not paying or not being eligible for dividend reinvestment, I think, is only applicable if it's held outside of the Roth. If it's held within the Roth, you can set that function up to actually reaccumulate and set it up on a drip when it's considered dividend reinvestment program. And in a managed situation, guys, they're going to you're going to pay for that every single month. They're going to charge you a few dollars, a few percentage points, or a flat fee to go in and set the drop down to dividend reinvest your capital gains. So if you guys do own VOO or VTI or any of the other ETFs or index funds or even mutual funds in your guys' self-directed account, keep in mind that the ETFs will actually not only pay you a cash dividend if you tell it, but it will reaccumulate shares for you. All right. What do I think about Micron? Buy it. You're getting a good entry point. Micron's not my favorite chip stock. AMD might be a good buy here. I know a lot of YouTube channels. I know some folks that I don't cover AMD. I was actually the most tempted today to actually buy Intel. That was the most tempting. I was looking at both Intel and Cisco. I actually traded out of them this week to shore up some cash. I made good money. Believe it or not, there is money to be made in the stock market. I was willing to go long both stocks. They ended up running up during that 2-day run up in the stock market. And I ended up selling out of them. But I actually almost repicked up back Intel again today. I didn't. I held off. That was my decision. But Micron is a buy here, less than $50 a share. You bet. Just sub to Average Joe. Awesome. I'm sure he'll appreciate that, man. Sincere guy, man, no doubt. Freaking probably put him in the camp of hardworking people trying to get ahead in life. Yep. And I hope he appreciated me, kind of giving him a plug. That's, I'd do anything I could do to help that guy. No doubt about it. Awesome, dude. Do TSP Roth contributions count against a self-directed Roth IRA contribution? Meaning, can I max out both? You can max out both. If you're part of the military, and I really shouldn't say this on a general forum, but that's one of the many benefits is that you can actually participate in both. Okay. Now, if you were a civilian, you can only own one. You can't just go from, your Merrill Edge self-directed and also go to TD Ameritrade and start two Roth IRAs. You're only eligible for one. But if you do participate in the TSP, you can, in fact, do the Roth TSP and your self-directed account. It's exactly what I do. It's exactly what I do. So really, there's a maximum capacity there to tax protect. You got 18,500 on the TSP, right? Devoted to the Roth, to the TSP Roth, and then your self-directed account with 5,500. Now, if you're married, you double that. So a great opportunity, depending on what your income is, to tax protect quite a bit of money. It's amazing how much you can save by having a budget. Thank you for all your valuable advice. Ernesto, thank you. That's awesome. I appreciate that. I just want to make sure I'm covering all these questions for you guys. All right. I'm pretty aggressive on scanning through here. Who's on here? Thanks for the kind words. It's super important to learn from more than one perspective. And I learned more from you than most of my favorite investing books. Amazing information from someone who, the funny thing about that is, man, I've learned so much in the stock market just by being a participant in the stock market. And the last thing that I want to see is people get involved in the stock market and think that they're going to be free of mistakes. You guys, you're going to freaking make mistakes. Just like you make mistakes with your freaking car, you make mistakes in life. Every now and then you are going to trip and you're going to fall. Okay. And I don't preach that enough. I always talk along the lines of do 1, 2, and 3 steps, right? Get invested in the self-directed Roth IRA. It'll help wealth preserve and tax protect. I'm right on that. Okay. I am absolutely 100% crystal clear correct. Now, it's how you take those 3 points and deploy them into the stock market that's going to define your success. And do not think for a second that if you invest over a 40 or 50 year time horizon, or some of you guys that are, 30 or 40 my age, right, that you're going to invest for 20 years and not make a mistake. The idea is that you learn from your mistakes, you evolve from them, and take a little bit of confidence in yourself, man, that you're participating in the stock market. It's so key. It's so key. But thank you for that. I really appreciate it. Really, I'm always learning. I'm always evolving as well. I'm not free of mistakes, but I tell you what, one of the key nerves as to why I came out with the Independent Investor channel is because of the amount of people that I talk to that are deficient in their knowledge about finances. No doubt about it. And I'm no analyst. I'm no expert. I am no financial planner. I'm just a regular hardworking guy. So what I'm trying to do is bridge the gap on what people think they have to know and what I'm telling you is the minimum that you need to know to be successful. And the disconnect between those two, quite frankly, is the success that I define on the channel. No doubt about it. Genuine in the same boat. Yeah, that's true. I wish I saw his program before I saw Robinhood. It gets misconstrued a little bit. My thoughts on Robinhood. I just want to make sure that I'm protecting the general community from going on there and I get to trade for free, because that philosophy is not the way that you want to approach the stock market. Okay. If you're downloading Robinhood with the intent of free trades, it puts you into this mindset that, wow, I can trade for 100 times during a potential year and I can do it all for free. It's the complete opposite of what I'm trying to teach people. And that is enter the stock market passively, right? Get up to those maximum caps of passive investments within your portfolio. enter into a good quality blue chip. I have no problem with that, but do it passively. And Robinhood does not promote that type of activity because everybody wants to start it to trade for free. And so if you're going to do it, and I talk about this all the time, many people who are entering Robinhood are doing so in the reverse order that I teach, right? If you want to get this self-directed account started, solidified, and if you're married, times it by 2, and you have no problem funding it at $11,000 at a time, then look at Robinhood if you're so hell-bent on starting Robinhood. But I still contend my brokerage house with Merrill Edge that I have, in addition to my self-directed accounts times 2, I have it all on the same screen. So why do I need Robinhood? I trade for free in Merrill Edge. And a lot of you guys are talking about, well, Robinhood is great because if you start with $200, it'll save you that $7. Yes, but again, come back to my fundamental premise of, you honestly kind of you're encouraged to trade in and out of stock to really realize the full benefit of Robinhood. Whereas if you're a new investor and you're in your early 20s looking to get started, that shouldn't be your philosophy at all. It should be to take advantage of entering into passive positions. And a lot of accounts will provide you a few trades to start off and get that baseline started in there. So you're trading, you're starting those fundamental positions to start for free anyway. So there's no real reason to opt for Robinhood right away. If you want to do it later on, go ahead and do it later on, but don't do it initially at the expense of a good retirement account. All right. Thank you for that question. It was awesome. The stock market will humble you to your knees. Somebody I know said that, right? It was funny because I said that during a video. I just felt like YouTube was crazy, man. When I started Independent Investor Channel last March, there was some channels, and I'm down on some other channels, and I don't care. I'm entitled to my creative opinion about it. Hell, they can have a problem with me. I have no problem with that. I've got one rogue person who comes onto my channel and dislikes my video, and I'd love for them to actually offer up why they're disliking my video, because my content is free of charge. So my message is just aimed at helping people. So if that's not loyal enough, I'd really like to understand what that person is so down on. But yeah, man, the stock market will humble you to your knees. And for you guys that are getting started in 2018, you're learning an aggressive lesson, but you'll come out of it tougher. Trust me, if you invested in 2017, the only thing that you learned from that, and it could be very misleading, is if you only invested in 2017 and you were like, man, this is awesome. All I've got to do is invest in GoPro and win. And that's all I have to do. And I can retire and quit my job. You're getting a false sense of security, because the volatility index right now is actually commensurate with where the volatility index is historically. It's historically around 21. It's at 24 right now. This is a normal market. This is what it does. So this is actually giving you more of an indication of what the stock market has to offer to you guys. And you have to be acceptive of that. And I feel like a lot of people were kind of being led astray a little bit, in that all you have to do is just invest in the stock market and you'll make money every day. In 2017, that was true, but not historically at all. And a lot of people got overzealous, man. And a lot of people got on there, and they actually admitted to being hurt by some of those, recommendations. And man, being hurt in a bull market in 2017, where the S&P 500 turned back 20% just from a passive perspective. If you took a downturn in your portfolio, you are on the wrong road. You're on the wrong road, and you needed to correct that, learn from your mistakes, and get on the right road. All right. Thanks for your advice and time. Really like your videos. Thank you. I appreciate that. That's awesome. The ability to reinvest ETFs, actually a function of the broker itself. If your broker allows it, great. Yeah, maybe. I don't know. I was just surprised because my partial shares were bought on both VTI and VOO when they were paid this week. And I've passed contrary information to that based on everything that I've read online about ETFs only paying a cash dividend. So good to know. It may be subject to the broker that you have. Okay. I'm with Merrill Edge. You guys know that. And I'm telling you, that's what they did for me. So I'd love to spark up a discussion. If you guys hold these assets within your accounts with other brokers and they're not allowing you to initiate a drip on those particular assets. Okay. But thank you for pointing that out. You could be very right. I don't know. I own Blackstone Group and have done research before buying, but have recently came into some concerns. Have you found Blackstone to be dead money, or has buying on the dip and collecting dividends proved fruitful? Oh man, yes and yes. It's been dead money, and yes, I've bought on the dip. I bought all the way into the low 20s. I bought initially at this buy point right here at $30 a share. It's really frustrating. I've seen the stock go up. Look at Blackstone Group in a different manner. I will look at the research that you're looking at, certainly, because what you've said there is a little bit concerning. They hold $1 trillion portfolio. I'd like to know what you mean by some concerns that you have. Definitely. But the 8% dividend, look, if you were going to buy, I almost buy these limited partnerships with the sheer intent of not buying a bond fund. Okay. Because if I can make an 8% return, I love when Blackstone pays the dividend because I get paid like 4 or 5 or 6 dividends. It's all kinds of different dividends in a limited partnership. Cumulatively, I make 8%. I can't make that in a bond fund. One of my favorite bond funds is B&D with Vanguard. I could certainly just go there with a little less risk than Blackstone. I understand that it's still a stock and a limited partnership at that. But it's honestly I haven't lost money with Blackstone Group. I've made money and I've accumulated a ton of shares. I would have to look into it and see how many shares I've actually accumulated in it, because I've owned Blackstone Group for going on 5 years, no doubt. And I've built up a nice position in the stock, no doubt. I've never sold it. I rode it all the way down to the 20s. I bought more. I'm sitting on around 165 shares right now, right around a $5,000 position. And I'm going to continue to own it because it's providing me that 8% dividend year over year. And I've got it on a drip. It just buys me more shares. So the idea there is that I'm just accumulating going forward. Right, wrong, or indifferent. That's kind of my posture on Blackstone. But you've perked my curiosity. I will look into it. So many people. Oh yeah, AJ. He's talking about Robinhood. I think he's one of those guys. I know Nate O'Brien. He does use Robinhood as well, and he uses it in the correct manner. If you hold the stock for over a year, then good. You're going to be subject to only long-term capital gains tax. The lower tax brackets won't be subject to that tax. So you're actually wealth preserving because you're not being charged a fee, right? And you're tax protecting. So I'm all about that, guys. The problem I have is having to be stuck, having to hold the stock for 365 days to get into that long-term category. Whereas, I would rather have you have the option if you were up in a position like a Facebook and it ran up 50% and you're at day 182, I'd like you to have the option to take profits in that account. And Robinhood does not provide you to do that. So that little $7 fee that you're saving to end up exiting the position really doesn't seem that large if you're kind of restricted in holding the stock long term to avoid the capital gains tax. So pretty awesome. Thanks, AJ. Appreciate that. Try to get haters gonna hate. Yeah, no. Hey, listen. I didn't know what trolling was before I started this YouTube thing. You guys have to understand, I'm the most anti-social media fella, but whatever. This is the best way to get my word out. I guess so. I don't understand that. I watch channels all the time that I disagree wholeheartedly with. I know they're misleading people. I know they're leading people. And I read the comments and there's very little hate on there. There's very little people going on and being like, what the hell are you talking about? That's wrong. People really want to follow, no matter what the advice. And I guess you just can't save everybody. And you're right. You can't appease everybody. But, I agree. I guess it's got to make me tougher. Fidelity allows you to reinvest your ETF dividends. Nice. Thank you, Ernesto, for that. That's awesome. It's something that I didn't know before this week. So Michael's talking about the BX at 33. I think that's a good entry on BX, but I'm going to look into that more. You're going to make an 8% dividend to boot. So if you've got zero capital appreciation, just use your imagination and imagine that you actually hold it instead of a bond fund. That's kind of what I do, because I would rather hold a stock, a limited partnership with that much better potential for capital appreciation, and in the meantime enjoy the 8% dividend. It does fluctuate. The dividend fluctuates down from 6 to 8% in Blackstone, but I've enjoyed owning it, honestly. Haven't lost a dime with it. I have bought on the dips, and I'm just looking at it being whacked with the rest of the market right now. But it was nice when I was actually up quite healthily. I was up 10% with the dividends reinvested. So I was actually doing quite well. They sell them outside. Man, I could get you one, no doubt. I tell you what's even harder to get. I was down there Saturday actually for the bull. Dave's talking about my bull, and I want the bear as well, because they only sell those down there as well. And I don't know. I watched Scribner's video this week, and he's got a little miniature version of it. So I got to hit him up and tell him he owes me. He stole my idea, man. So I'm gonna tell him, man, he doesn't own the patent on the freaking bull. I do. So he's got to pay me a 2% royalty on all of his videos, man. Make me a rich man, because he's doing quite well. But his bull's he's like a baby bull. You know what I'm saying? But I want the bear. I'm gonna get it next time I go downtown to Wall Street, man, for sure. Pretty awesome. Anyway, guys, listen, 111. I try to keep this as engaging as I can. There was awesome engagement tonight. I hope you guys got some value out of this. Certainly kind of put a plug in there for my Facebook group. I have a really good feeling that's going to be kind of one of those key conduits to keeping the dialogue going for people. I don't want to promote disconnect on this channel. I certainly want to remain connected. We get the questions answered. It's not, as immediate a service as maybe I would like. There's only one of me, but I've got a lot of people in the group. I'd love Dave to kick over there to the Facebook group, man. Your input would really, there's a couple other channel creators there that I endorse, man. And I would be humbled if you'd come over there. I'd love for you to start it. I'm going to be coming out with a successful YouTube, or how to build a YouTube channel. I think I've probably made every mistake with YouTube as well, and I'm still making them. I think I'm screwing up somehow on my search. That's why I get like 300 videos, but I'd like to set the record for coming out with a channel that actually puts the most videos on YouTube, and gets the least amount of views. So I'm cool with it. I think for the few hundred people that actually really follow the channel, that's where the value lies with me. No doubt about it. The value lies in the loyalty of the subscribers that are tuning in, and they're finding value in the message, because it's there. It is there. No doubt about it. So I thank you guys a ton. Thank you, Nyella. Hope you're not too cold up there. Hopefully it warms up a little bit in Canada. Thank you for joining the group, guys. And again, kick over to the Facebook group to keep the discussion going. I'm glad to be with you guys on a Friday. Stay tuned next Friday. We're going to do the same thing. I'm going to do these all the way up until my relocation, to kind of stay connected to you guys. And then I'm going to be taking a hiatus from the channel. And that's the way that it's going to be, guys. But thank you so much. Good luck in your next week of investment. And I'll catch you guys next week, guys. Thank you so much. I'll talk at you later.